Welcome to The Explainer. Today, we're diving into a question that's moving from the sustainability department straight to the trading floor. How do you connect the dots between a company's sustainability report and its actual stock price? We're going to break down the exact financial mechanics that turn environmental and social data into tangible enterprise value. All right, let's kick things off with a number I pulled from a real corporate report. 1.88 cubic meters. So what is this? It's the amount of water a company used for every single ton of product it made. Now, on its own, it's just a data point. Yeah, we can see they got a little more efficient compared to last year's 2.01, and that's great. But really, what does this number tell an investor? And that right there is the central puzzle we're tackling today. How in the world does a physical metric, like how much water a company uses, translate into dollars and cents on a balance sheet? How does it influence an investor's decision to buy or sell? Seriously, how do we get from cubic meters of water to enterprise value? Well, the thing is, raw sustainability data is a lot like a company's financial statements. It needs some real analysis to unlock its meaning. Think about it. No serious investor just looks at a single line item on a balance sheet in total isolation and decides to pour millions into a stock. It just doesn't happen. And it's the same way with these ESG numbers. They have to be unpacked, compared, and put into context to really understand their true financial impact. Okay, so let's get into how it's done. To make that connection, analysts use a pretty clear framework that maps sustainability performance directly onto a company's core value drivers. You can think of it like a blueprint for turning these sometimes abstract ESG ideas into very concrete financial outcomes. And here's the key insight. You've got to understand that sustainability issues aren't just some fuzzy, feel-good halo around a company. Things like poor environmental management or, on the flip side, really strong employee engagement, these have real, measurable effects on the specific financial levers that determine a company's profitability, its growth, and its risk. Now this lays out those four primary channels beautifully. First up, revenues. Just imagine a company whose products are certified sustainable. That can grab new customers, maybe even let them charge a bit more. Second, you've got expenses. A grocery chain that invests in energy-efficient freezers isn't just cutting its carbon footprint, it's directly slashing its monthly electricity bill. Simple as that. Third, assets and liabilities. Picture a solar developer whose projects are always getting held up by protests. Well, those assets are suddenly worth a lot less because they're not generating cash. And of course, environmental screw-ups can lead to massive fines, a huge liability. And fourth, the cost of capital. This one is all about how risky a company looks. The better a company handles its ESG risks, the more stable its future looks, and the cheaper it is for that company to borrow money. So now that we have these four channels, let's see how they plug into the main tool that analysts use to figure out what a company is really worth, the discounted cash flow model, or DCF. This is where the rubber meets the road in financial analysis. Conceptually, DCF is built on a super simple but powerful idea. A dollar today is worth more than a dollar tomorrow, right? Because you could invest that dollar today and earn a return on it. So to figure out what a company is worth, a DCF model basically forecasts all the cash it's ever going to make in the future, and then it discounts all of that cash back to what it's worth in today's money. Okay, here's the simplified formula. Now, don't worry, we are not about to do a bunch of complex math here. The focus is just on understanding how the pieces fit together. CF is just the cash flow for a certain year, and R is the discount rate. And that R is the really crucial part. The higher that discount rate R is, the less all that future cash is worth today, which means the lower the company's valuation. And here's the punchline. Those four financial channels we just talked about, they feed directly into the two most important inputs in this whole valuation model. All that information about a company's sustainability performance lets an analyst make much smarter guesses about its future cash flows and helps them set a much more accurate discount rate. And this just shows you the thought process perfectly. So, step one, the analyst looks at the ESG data. Let's say a company reports that workplace accidents are going up. Step two, they figure out which financial channel that hits. Well, that's going to impact expenses, right? Potential fines, lost work hours, and it also signals higher operational risk. So step three, they adjust the DCF variables. They'll probably lower the future cash flow forecasts to account for those costs, and they will almost certainly bump up the discount rate to reflect that higher risk. And the result? A lower but much more accurate valuation for the company. Now let's dig a little deeper into that risk piece, because this is where it all really comes together. That discount rate, R, is fundamentally just a measure of risk. It's the return investors are demanding to make up for any uncertainty. This quote really is the bedrock of finance. Risk and return are just two sides of the same coin. If a company's future looks shaky, maybe its factories are in areas with water shortages or it's facing new carbon taxes, investors are going to demand a higher rate of return to bother investing. And that higher required return forces an analyst to use a higher discount rate in their model. This slide just shows that trade-off perfectly. Okay, on the left, you have a company with high ESG risk. Let's say it's a mining company with a terrible safety record. Investors see a higher chance of a disaster, lawsuits, big fines. All that uncertainty means higher perceived risk, which leads to a higher discount rate. And when you plug that higher R into the formula, boom, the company's valuation goes down. Now on the right, you have a company with low ESG risk, maybe a food company with a totally transparent certified supply chain. That reduces the risk of recalls or safety problems, so investors see more predictable cash flows, they perceive less risk, and they use a lower discount rate, which in turn boosts the company's valuation. So, let's pull all this together. What is the big takeaway here? Why is it such a game changer to rigorously connect sustainability data to financial models? It's because this whole approach is fundamentally changing how the market defines and measures value itself. And it matters for everybody. For investors, it's about seeing the whole story. A company's carbon emissions or its employee turnover can be huge clues about its future financial health, revealing risks that old-school accounting might totally miss. For companies, this moves sustainability from just being a cost to being a real value driver. I mean, when you can prove that investing in water efficiency directly leads to a higher valuation, it gives management a powerful reason to act. And for the market as a whole, it just means money flows more efficiently to companies that are better managed and built to last. Which leaves us with a final thought, a provocative question, really. As this blend of ESG and finance becomes totally standard, are we hurtling toward a future where a financial valuation that doesn't account for a company's sustainability performance will just be seen as, well, incomplete or maybe even negligent? Based on the framework we've explored today, the answer seems pretty clear, doesn't it?